year. Some of you probably know that this year, 2025, is the Chinese lunar year of the snake, and that's actually quite an inauspicious year of the zodiac. It's the only year, or the only zodiac year, where the average stock market return is negative, and that's because it has historically been a year of significant friction and change. So 1929, the Wall Street crash. 1977, which was a -18 on the US stock market, the year the Sex Pistols came, the year that the Vietnam War broke out, which I think was 1965, 2001, which was of course 9/11, the invasion of Afghanistan, and a US recession, along with the bursting of the dot-com bubble. So it's a dangerous year actually for geopolitics and for markets, but it will hopefully give you some comfort that we're not investing based entirely upon lunar forecasts. We do have some other views which we can come on to in a minute. But if we could turn the page, I'll give you a brief overview of Ruffer, or an intro for those of you that haven't met us before. We are a global multi-asset, go anywhere, absolute return strategy. And we have been doing this one thing for 30 years, since 1995, and we manage about £20 billion. The Ruffer Investment Company is our £1 billion UK listed investment trust, which is probably the fund most suitable or interesting for people on this call. The long-term track record of Ruffer is on the slide there. So 30 years with a compound annual return of 8% per annum after fees. Is good. It's a long track record, which is nice, but really what is useful about that track record is the diversification and correlation characteristics that it brings to your portfolio. So equity-like returns are fine, but what is interesting is that we have historically delivered those returns with bond or hedge fund-like volatility, so much less volatility than the stock market. The stock market has 20 or 50% falls a couple of times a decade. Our biggest peak to trough loss is 10%, but also it's that we're best known for making money during crises. So the 4 big crises in the firm's history are shaded in green there. We had positive returns through the dot-com crash when the market halved. We were up 20 in the financial crisis when stock markets halved again. We were positive through the COVID crash in Q1 2020, and we were up mid-single digits in 2022, which was, feels like a lifetime ago now, but that was the year that diversification failed. Stocks, bonds, many other alternatives, property and so on, were all down. So that's why it's interesting. It's a truly diversifying asset to put into your portfolio. Now, today, our view is really the antithesis, we think, of the extremities and certainties that we observe in the market. And now you're all dialed into a call about alternatives, so I'm going to take that as a positive that you're maybe interested in hearing about a different view from the one that the market seems so sure of. So if we go on to the next slide, this is US valuations. Now we see a starting point in 2025 of extreme valuations, and on top of that, sentiment and positioning that looks very full, along with signs of froth in stuff that's going on. Now, we can leave aside for a minute the fact that the rest of the world, the UK, Japan, emerging markets, are not as expensive, because the US absolutely dominates global markets and is to many degrees the only game in town. And as you can see here, it's about as expensive a market as we've seen in the last 50 years. And what's interesting about all these different valuation metrics, you don't necessarily need to know how they all work, but they all have different inputs. So the price to earnings is an income statement metric, price to book is a balance sheet metric, cash flow is a cash flow metric. They all use different inputs, but they all have a uniform conclusion, which is that stocks are about as expensive as they have ever been. And the other thing I would say is that a lot of people will say, well, if you strip out the Magnificent Seven, the big tech companies, then the US isn't that expensive anymore. That's just not true. If you look at companies like Walmart or Costco, great companies, but pretty dull when it comes to their growth outlook. They're so big already, they just sort of grow at the same rate as the economy. Costco trades on 51 times earnings, and Walmart trades on 35 times earnings. So very, very expensive stocks. There are quality businesses, but definitely at nosebleed valuations. So why does that matter? If we go on to the next slide, it matters because valuation is gravity, a very, very powerful force, and over the long term is sort of impossible to resist. Over short periods of time, however, valuation is pretty useless. This is JP Morgan data. On the left-hand side, you can see on the horizontal axis, you have the forward price to earnings multiple, so the valuation of the US stock market. And on the vertical axis, you have the return that you've earned. This is nominal return, including dividends. And you can see on the left-hand side, the 1 year return, it's not predictive at all. High valuations doesn't mean the stock market won't go up more tomorrow. But on the right-hand side, a very powerful and highly predictive pattern. High valuations tell you that longer term, 10-year in this case, expected returns are very low. And that is a major warning. You know, we know that we are dancing on the edge of a volcano here, that things could go very badly wrong, or even if they don't go badly wrong, the returns won't be great. But I think a good example of the current attitude to keep dancing is David Kostin from Goldman Sachs, their chief strategist, recently released a report with a similar forecast to this, that US equities will do 2 or 3% per annum at best over the coming decade. But what's his 1 year forecast? Plus 13. And it's this sort of Lord make me chaste but not yet mentality seems highly prevalent. So if we go on to the next slide, valuations tell you a lot, but not much about short term. What we can look at is things like sentiment and positioning to see where we are in a shorter term cycle. And what you've got here is evidence that fund managers, professional investors, are very long stocks. So you can see there a near record level of overweight equities, and that's funded from cash, where they have near record low cash balances. And you know, we're supposed to be the professionals here, but look at the swing from September 22. At the market bottom back then, everyone was bearish and underweight equities. Today, pretty close to all-time highs on the S&P, everyone is bullish. There's a huge contrast there. We go on to the next slide. It's not just the professionals, it's also retail investors and households. So this chart shows you the US household allocation to equities, and you can see that US households are all in. This is Federal Reserve data, and it shows you that 41% of household net worth is invested in equities in the US. Now, that is a very high number. You can see in the past it's been a bit of a contra-indicator. So households were all in 2021 before 2022's market falls. They were all in back at the peak of the dot-com bubble, and they were all in back in 1966 when equities then did nothing for 18 years. So that is not a positive sign that households have more equities than they've ever had before. And I would supplement that with a recent survey from the Chicago Fed, I believe, which showed that US retail investors are the most bullish they've been in the last 50 years, which is pretty notable. Part of that because of the election of President Trump. And then a survey by Natixis, which is a French bank, which surveyed underlying financial advisor clients and showed that they're expecting a 15% annualized real, so after inflation, return on their investments over the long term. Now, those of you who, like me, take the Dimson Marsh study or the Barclays Equity Gilt study to bed with your Horlicks will know that the long-term real return on equities is more like 5 or 6. So that gap between expectation and reality, we think, makes markets really quite vulnerable. We go on to the next slide. Another useful indicator, I think, is the ratio of insider selling. So Q4 2024, the quarter just completed, was a record in the last 25 years for the amount of insider sales, so that's corporate executives and employees selling stock in the company that they work for relative to purchases. Now, the red line here is a 52-week moving average, but you'll have to trust me that for the quarter, it was a record. Now, this is interesting. For For every dollar of insider purchases, people buying the stock of the company that they work for, there were $25 of sales. Now, that's interesting because insiders have the best seat to tell you whether what they see on the ground at the coalface matches the enthusiasm that we can observe in the stock market. And the fact that they're selling in droves would suggest that they don't see that matching up. So moving on, we talk about elements of froth and euphoria in markets today. In 2021, we talked about an excess of excesses. And sorry, if we go back to the Trump slide for a second. And what's amazing about that excess of excesses is that we had a huge drawdown in 2022, and yet here we are, we're back again, back at the party with cryptocurrencies going to the moon, stock markets all-time highs, lots of froth and speculation, and yet rates are 5%. I genuinely believe that was a zero interest rate phenomenon, and it does not appear to be. There's a famous phrase that nobody rings a bell at the top of markets, but actually on the 12th of December, President Trump went to the New York Stock Exchange and became only the second president ever to ring the bell, looking quite smug there. And even more than that, in the background, you can see that he was voted Time Magazine Man of the Year in the same week. Now, Time Magazine have been very good over the years at picking incredibly influential historical figures as their Man of the Year. They picked Jeff Bezos in 1999, they picked Elon Musk in 2021, Trump now, but in the short term, their timing is pretty terrible because in the year after Bezos was Time Magazine Man of the Year, the stock fell 90%. In 2021, I think Tesla fell 51%. So good long-term stock pickers, but not very good at market timing at Time Magazine. So if we could go on, one theme that is driving markets higher at the moment is the idea of US exceptionalism. America is a truly fantastic economic powerhouse. It has unique institutional advantages. It has unique geographic advantages. Post-financial crisis, it developed these amazing tech businesses now known as the Magnificent Seven. It became energy independent. It had superior demographics to Japan or Europe. There's a lot to like. And that's why I think every mania has a kernel of truth in it. And the kernel of truth is that the US is genuinely an incredible economic miracle, and AI's promise is absolutely real. But if we go on, a slide, all things in moderation, and this trend I think has probably gone too far. The US has outperformed Europe by multiples over the last 15 years. It has just in 2024, it had its best year versus Europe in 30, but we've now reached a point where the US is 74% of global stock markets. So to just put some numbers around that, the US is 5% of global population, it is 25% of global GDP, it's a third of global profits, but it's 75% of markets. The 7 biggest companies in the US are 20% of the global index, but they're bigger than Japan, India, Switzerland, France, and the UK stock markets combined. Nvidia, which of course was in the press last night, is the biggest company in the world. Nvidia alone is bigger than the FTSE All-Share. It's really quite remarkable. And in 2024 alone, the value of those magnificent 7 tech companies rose by $6 trillion, which is twice the entire FTSE, or 1 times the Nikkei, the Japanese stock market. So there's no precedent for this. That's the point I want to make. It doesn't mean it's wrong. It doesn't mean that it's definitely a bubble or a mania, but it means you have to think very, very carefully about allocating 70+% of your money to this, which is what you do if you're a benchmark investor. Because this could be, although the companies are great, the epicenter of an overvaluation mania. So if we go on to the next slide, America is the most capitalist nation in the world. Few will argue with that. But one of the consequences of being the most capitalist nation in the world is relentless competition. This is the largest 10 companies in the world by market cap. At the end of the 80s, you can see that Japan was actually dominant. At the end of the 90s, it was US tech exceptionalism version 1. At the end of the 2000s, it was all about commodities and emerging markets, Brazil, Russia, India, China. Jim O'Neill at Goldman Sachs called them the BRICS. Albert Edwards at Societe Generale called it a bloody ridiculous investment concept. And then today, it's the US and the US tech companies in particular. And the point I want to make here is that this just demonstrates how cyclical and fashion-led these markets are over long periods of time. If you're at the top of this list, you have a target on your back. Everyone is coming for your spot, everyone is coming for your profit pool. And that's why only Microsoft and Exxon have really managed to stay on this list for an extended period of time of multiple decades. So if we go to the next slide, sorry, I should say it's not obvious on that last slide. The reason that matters is that if we recut it in 4 or 5 years, it's highly likely that some of those tech companies will drop off, and that means that they will have significantly underperformed the index, and whatever replaces them will have outperformed the index. So another thing that's getting markets very excited at the moment is the return of President Trump. Now, Maya Angelou, who's a famous author, once said, when someone shows you who they are, believe them the first time. And we already know what President Trump looks like because we saw Trump won in 2016. So investors are reaching for the same playbook, and that playbook is very positive for economic growth, and it's very positive for asset prices. So that is reasonable, but I just want to point out that the starting point is really quite different. Back in 2016, the US was grappling with very low growth, very low inflation. It was called secular stagnation. That was the economic phrase of the moment. And Trump's tax cuts and his deregulation that he brought unleashed animal spirits, let growth accelerate, and let asset markets rise. But today, very different picture. Debt is much, much higher. The deficit is wider. Growth is already strong in the economy. Unemployment is already very low. Wage growth is already strong. Inflation is now a persistent problem to be battled with, and taxes are still low from the first time round because they never went back up. So I just think we need to be wary of rolling out the exact same playbook as the first time round, and also acknowledging that valuations and sentiment, like I said earlier, are just much higher this time round. So if we go to the next slide to sort of bring this towards a conclusion. Russell Napier, who's a famous market commentator that's based up in Edinburgh near me, told me early in my career that markets are just people in rooms telling stories to each other in essence. And it's quite similar to this idea that I like, that prices make opinions. So people look at the price that they see on the screen in front of them, and they backfit a rationale to explain it. And that means that the stories that we hear are so much more compelling when they're coupled with positive price action. And so today, the idea of US exceptionalism, of the Magnificent Seven dominating forever, of Trump being an unbelievably positive catalyst for the stock market, they all make sense because the price action reflects that. And that's why, frankly, with Ruffer performance not being so good over the last year or two, fewer people are willing to listen to our opinions. So what story is the market telling itself? It's saying we've avoided a global recession. Inflation is yesterday's problem because it's come down from 9 to 3. Interest rates have peaked and are coming down. We have a new pro-business president, and the potential of AI is the next catalyst for huge global growth. And that might be right. It absolutely might be right, but we're telling ourselves a different story. I think that's one that's worth considering, which is that the wall of worry has been climbed. Everyone was very pessimistic in 2022. Now everyone is optimistic. Inflation is persistent. We've had 48 consecutive months of above target inflation. The Federal Reserve in the US, the Bank of England in the UK cannot get inflation down to target. The chronic debt problems have not gone away. In fact, they've gotten worse. Deficit is structural, not cyclical. Government spending is out of control. Valuations are very high, so expected returns are low. Everyone is crowded into the same trades that have been working, and often the benchmark forces them to. So that's the US, it's AI, it's Magnificent Seven, it's quality companies, it's cryptocurrency. There are clear signs of extended positioning and froth. Things like Trump coin going to a $70 billion valuation in the weekend, lots of other nonsense in the crypto sphere. And when the market turns, it will turn quickly because of some inherent structural fragilities. That's our story. So how are we positioned for that? Is on the next slide. We have a defensive portfolio, and I call it a portfolio of ugly ducklings. It's a portfolio of assets that we think are attractive that nobody really wants to own. So we have 10% in inflation-linked bonds, so bonds that uplift with inflation and benefit from inflation protection. We have 7% in precious metals, but not gold, so gold mining companies, silver and platinum. We have a large allocation to the Japanese yen, which we think is the cheapest currency in the world. If you ever wanted to go on holiday to Japan, now is the time to do it. It is very, very cheap relative to history. We have derivative protections, which are a small bit of the portfolio, but which can punch very hard, which will rise if the market sells off or if we have significant disruptions to geopolitics or to markets. And on the growth side of the portfolio, because we always want to have an element of the portfolio that does well if we're wrong, i.e. the global economy continues to do well, markets continue to find new highs. We have 35% in equities and 6% in commodities like oil and copper. But the equities that we have look nothing like the benchmark. So we have a lot less in the US, we have a lot more in the UK, in China, in Europe, and we have an exposure to value stocks, to commodity stocks, global cyclicals, and much less in tech than the vast majority of managers that you might look at. So to summarize and close, we've got the cyclical wrong. We thought that the market pain in 2022 would translate into economic pain in 2023 and a recession. And therefore, because we got that wrong, the portfolio has had two pretty moribund years. But we asked people to judge us on our full body of work, which is that 30-year track record I showed you at the start, not one half cycle from 2022. I think I've hopefully presented, however quickly, some facts that the US offers a very unappealing risk reward from here, and that on the balance of probabilities, it's not a good time to be adding risk, and in fact, people should be looking to move to more defensive allocations, which is why I think we're all on an alternatives call. But in a strong equity market like we've had in the last 2 years, any allocation you've made to a defensive manager feels like too much. It makes you feel a bit silly. But in a falling market, I assure you, and remember 2022, in a falling market, any allocation that you have to a defensive manager, you wish it was more. And the balance really is up to you to find that sweet spot. But I think the time for that, as we saw yesterday with that pretty shocking NVIDIA news, the time for that could be now. Thank you.